Okay, so $100,000. Maybe you just sold something. Maybe it's been sitting in your savings for years. Maybe you inherited it. Maybe it's from a business. Doesn't matter how you got there. What matters is you've got it. And now you're staring at it going, okay, now what? And here's the thing that nobody really tells you. Having $100,000 actually makes a lot of people more nervous than having nothing. Because now there's something to lose. Now the stakes feel real. And that nervousness, it causes people to either freeze completely or rush into something dumb. Both of those are mistakes, and both of them are really common. So before you move a single dollar, I want you to watch this, because there are a few things you genuinely need to think through first, and a few options that actually make sense at this level. Let's get into it. Stop before you do anything. The first thing I want to say might sound strange. Don't do anything yet. Not forever. Not for years. Just before you make any move with $100,000, give yourself a beat. A week, maybe 2. Because this amount of money has a weird psychological effect on people. It feels urgent. It feels like you're losing money every day it's just sitting there. And that urgency makes people make rushed decisions. The market is not going anywhere. The opportunities are not disappearing overnight. And a week of sitting still is not going to cost you anything meaningful. What you should do in that window is get clear on 3 things. First, is there any debt in your life charging you more than 7% or 8% interest? Credit cards, personal loans, anything like that. Because again, just like I talked about with $1,000, paying off high interest debt is a guaranteed return. You cannot beat a guaranteed 22% return in the market. It doesn't exist. Second, do you have a real emergency fund? Not part of the $100,000, a separate fund. 3 to 6 months of expenses sitting in a high-yield savings account. If you don't have that, carve some of this out for it right now before anything else. Third, do you actually need this money in the next 1 to 3 years? For a house, for something big, something planned, because that changes everything about where it should go. Okay, assuming you've thought through those 3 things, here's where it gets interesting. The mistake most people make at this level. So here's what I see happen a lot when someone suddenly has $100,000 to invest. They feel like this amount of money deserves a special strategy. Like, okay, I've got serious money now, so I need a serious, complex, sophisticated plan. And they start looking at individual stocks, real estate deals, maybe even crypto, private investments, things they never would have touched with $1,000. And sometimes those things work out. But a lot of the time, trying to be clever with $100,000 is exactly how people end up with $60,000. The truth is, the boring strategy that works for $1,000 also works for $100,000. It just works on a bigger scale. Index funds, diversification, time in the market, consistent contributions, none of that stops being good advice just because the number got bigger. What changes at $100,000 is not really the strategy, it's the structure around it. The tax efficiency, the account types you use, maybe bringing in a professional for an hour or 2 just to sanity check your plan. That's what actually changes. But the core idea, put money into broadly diversified, low-cost investments, and leave it alone for a long time. That's still the move. Option 1, max out every tax-advantaged account first. Okay, so if you have $100,000 and you're not already maxing out your tax-advantaged accounts, that's the first place to look, your 401k. If your employer offers one, you can put up to $23,500 into it in 2026. And if your employer matches any of that, that match is free money. Like, literally free. Dollar for dollar up to a certain percentage in most cases. If you are not getting that full match, you are leaving part of your salary on the table. That has to stop. Your Roth IRA, up to $7,000 a year if you're under 50. The tax-free growth over decades on $7,000 a year adds up to something genuinely wild. If you're eligible, this is non-negotiable. If you're self-employed, you've got even more options. A SEP IRA lets you put in up to 25% of your net income. A solo 401k has even higher limits. These are incredible tools that a lot of self-employed people just don't use, which is honestly a bit heartbreaking when you see the numbers. Now, these accounts have yearly contribution limits, so you can't just dump the whole $100,000 into a Roth IRA at once. But you can max out this year's contribution immediately and then plan out the next few years. Tax-advantaged accounts first, always, before anything else. Option 2, a taxable brokerage account with a smart allocation. So after you've maxed out the tax-advantaged stuff, or if you've already been doing that, the rest of your $100,000 can go into a regular taxable brokerage account. And look, taxable sounds bad, but it's really just a normal investing account. You pay taxes on gains when you sell and on dividends when you receive them. That's it. It's not a trap. It's just how most investing works. The question here is what you actually put the money into. And again, for most people, a simple 3-fund portfolio or even just a total market index fund is honestly all you need. A total market fund like VTI at Vanguard or FSCAX at Fidelity gives you exposure to literally thousands of US companies in one single fund. Low fees, massively diversified, no guessing. You add an international fund like VXUS to cover the rest of the world. And maybe a bond if you want to soften the volatility, depending on your age and risk tolerance, and that's a complete solid portfolio. This is not exciting. I know that, but it works, and it keeps working decade after decade. If you have $100,000 and you put it into a total market index fund and left it for 25 years, at historical averages, you'd be looking at somewhere around $1 million to $1.3 million from one move that you made one afternoon. Option 3, real estate, but not the way most people think. Okay, so real estate comes up a lot when people have this kind of money. And I get it. It feels tangible. You can see it, touch it. It doesn't just exist on an app somewhere. Now, $100,000 is actually a decent down payment on a rental property in a lot of markets. If you go that route, the math can work really well. You put 20% down, the tenant basically pays the mortgage. The property hopefully appreciates over time, and you build equity. That's a real strategy, and it works for a lot of people. But, and this is a real but, being a landlord is a job. It is not passive income. Tenants call you. Things break, vacancies happen. Sometimes people don't pay. You need to actually want to do that job before you go that direction. If you want real estate exposure without being a landlord, REIT, that is Real Estate Investment Trust, are worth looking at. A REIT is basically a company that owns real estate and pays out a big chunk of its income as dividends to shareholders. You can buy into a REIT through a normal brokerage account, just like a stock. You get the real estate exposure without ever having to fix a leaking roof at 11 p.m. on a Saturday. Real estate investment trust funds aren't perfect for everyone, but as a piece of a diversified portfolio, they can make sense. Worth researching. What about a financial advisor, honestly? I want to talk about this for a second because I think there's a lot of confusion around it. A lot of people either trust financial advisors completely and hand everything over without asking questions, or they think advisors are all trying to rip them off and they avoid them entirely. Both of those extremes are not great. Here's my honest take. At $100,000, it is probably worth paying for 1 or 2 hours with a fee-only fiduciary financial advisor, not someone who earns commissions on what they sell you. A fee-only advisor charges you a flat fee for their time and has a legal obligation to act in your interest. That's the kind you want. 1 or 2 hours with the right person can help you figure out the right account structure, the right allocation for your situation, and whether there's anything you're missing. It might cost you $200 to $500 for that session. On $100,000, that is a tiny expense to make sure you're not making a $20,000 mistake. You can find fee-only fiduciary advisors at napfa.org. That's a real resource. Check it out. This is not me saying you need someone to manage your money forever. You probably don't. But a one-time check-in when you're making a big decision. Genuinely worth considering. The thing nobody talks about, the emotional side. Okay, so this is not a finance point exactly, but I think it matters. When you have $100,000 invested and the market drops 15%, you're looking at a paper loss of $15,000. That is not a small number. And for a lot of people, especially people investing serious money for the first time, that feeling is enough to make them sell, to pull out, to go back to cash. And that is almost always the wrong move. Because selling when the market is down locks in your loss. The market has recovered from every single crash in history. Everyone. But only the people who stayed in got to recover with it. So before you invest $100,000, I want you to genuinely sit with this question. If this dropped to $75,000 on paper tomorrow, would you panic? Would you sell? Because if the honest answer is yes, you need to think about your allocation. Maybe you need more bonds, maybe a smaller portion in stocks, maybe a bigger cash cushion sitting separately so you feel safe enough to leave the invested money alone. Knowing yourself here is not weakness. It's actually smart investing. So, to bring it all together, before you move anything, check for high-interest debt, check your emergency fund, and think about your timeline. Then max out your tax-advantaged accounts, your 401k, your Roth IRA, whatever you're eligible for. Put the rest into a simple, low-cost, diversified portfolio in a taxable brokerage account. Consider real estate if you actually want to be a landlord, or real estate investment trust if you just want the exposure. Think about one session with a fee-only advisor and prepare yourself emotionally for the market to go up and down, because it will. That's it. That's the whole thing. $100,000 is a genuinely meaningful amount of money. And the best thing you can do with it is resist the urge to be clever, resist the urge to rush, and just put it to work in a way that's boring, consistent, and built to last. The people who build real wealth aren't the ones who made one perfect move. They're the ones who made decent moves consistently and didn't panic when things got uncomfortable. You've got $100,000. That puts you way ahead of most people. Now just don't blow it trying to double it overnight. Drop a comment and tell me where you're at. Are you thinking index funds, real estate, a mix? I read every single one and I genuinely want to know. And if you want me to go deeper on any of this, how to pick between funds, how to actually find a good advisor, just say it and I'll make the video. See you in the next one. New video every week. Subscribe so you don't miss it.